So welcome to everyone. We will start our quarterly call for domestic resurgence portfolio soon. We'll just wait for a couple of minutes for people to join in. Thank you. Good evening, ladies and gentlemen. We'll just begin the call in 1 minute. It's 4:01 and we'll start soon. We're just waiting for participants to log in. So welcome everyone to today's call. Today's quarterly update is on the domestic resurgence portfolio, and we have with us the fund manager for the portfolio, Kuldeep. Kuldeep has been with ASK for close to around 7 years and has been a professional in the financial markets with over 16 years of experience. So worked with companies like HSBC, and then with ASK for a very long time, and he was our consumer analyst, and now he manages a few funds for us. One of them is Domestic Resurgence Portfolio. So Domestic Resurgence Portfolio is one of our best performing portfolios, and not just with ASK, but across peers. It has done well in the recent times and throughout its life cycle. It's a very interesting fund, and I'm sure you all would have heard from us earlier. So in today's call, the idea is to discuss what we've done in the quarter and what is the outlook. So over to you, Kuldeep. And before we start, to all the participants, do follow us on our YouTube channel and our LinkedIn channel to keep receiving such updates of our calls. Thank you. Over to you, Kuldeep. I shall go on mute now.
Hi, good afternoon, everyone. Thanks for joining in. So before we come to portfolio, it's equally important that we realize the environment we are working in. So global indicators, good news is like India is among the best performing markets, not only in near term, even if you look for the longer term, like 3-year, 5-year, India stand out. So from 3-year perspective, India has delivered almost 15% CAGR. From 5-year perspective, almost 13% CAGR, and probably the only market delivering double-digit return when the longer time frame is being concerned. As you might be noticing in last couple of years that whether you go to any news channel, newspaper, you come across the concerns being voiced by many commentators like world is facing problem on different count. So macro challenges, whether emanating from the geopolitical situation and so on. And the impact of the same was that commodity started moving up sharply, especially post-Russia-Ukraine war, and it resulted in significant inflationary pressure. So last year, October 22, if we look globally, most of the developed market had either high single digit or low double digit inflation. And this led to a situation that central banks have to respond. And they did it by raising the interest rate. Today, we are relatively more comfortable in a sense that the inflation is moving downwards and the numbers are relatively more manageable. So now it's a low single digit inflationary scenario as we speak. And why it's happening so? Like if you look whether say agri commodities, metals, etc., many things have come down sharply from their peak. Crude had been quite volatile in last couple of years. Post Russia-Ukraine war, there was a sharp movement in the crude oil prices, and after that, it kept on coming down, providing some respite on the inflation front. And then the Israel-Palestine war broke up, and that's the reason we saw that almost 30% movement in the crude oil, moving right from say $72 to $95 plus. Uh, the things are settling down and again coming to more manageable range of close to $80. So we know global inflation is significantly influenced by say, crude oil prices. So when crude oil prices are controlled, it is a good news in relative sense. As I mentioned that when the inflation was inching up, so most of the central banks were responding to the same by increasing the reference rates. So Fed rate increased by almost 500 basis point plus, and same was the situation more or less in EU. And as you can see that now the inflation is coming down. So we will like to believe the interest rate upcycle is largely over. On further tightening, if at all it happens, it will be relatively quite modest. In fact, next year, second half of the calendar year, we may think about a scenario that there can be some easing on the interest rate cycle and we can start observing some rate cuts on the Fed side. So we have seen when crude oil prices moved up in recent time, US 10-year bond yield also moved beyond 5%, and it again led to a jitters in the global equity market. Since then, there is some respite. The 10-year bond yield in the US has come down to 4.5%, and things are relatively more comforting vis-a-vis say the situation a couple of months back. With this backdrop of the global indicator, if we look the domestic scenario, our own economy had been relatively quite resilient. It also reflected that when US raised its interest rate by more than 500 basis points, tightening in our own domestic fund was relatively lower. That's the reason the gap between, say, India 10-year bond yield versus US 10-year bond yield has come down. So when the global market rates are moving up, Indian market have also need to move up just to maintain the parity or say keep on attracting the foreign capital. But at the same time that today probably we stand out in terms of say global economic situation. We are much better placed than many other countries. If we think about the situation on ground, so diesel consumption, petrol demand, both moving up mid to high single digit. It suggests the buoyancy which is there in the domestic front. Train traffic moving up in high single digit, air traffic moving more than 10% or so. So it suggests that a lot of ground activity is happening and net the things look better in time to come. So if you look the overall consumption which is fueled by say, credit card penetration and spending, so credit card transactions have gone up by almost 11%, overall spending more tin 15%. All in all, suggesting that despite having tough global macro backdrop, we are relatively better placed. We have better resilience. Our local factors are doing good, and when a sense of stability come into the picture, probably we should do even much better in time to come. So the way we have seen the inflationary scenario globally, the similar had been the situation in India as well. Like last year, October 22, if the inflation was close to 7%, this number has come down to less than 5% in October 23. So I would say it's more manageable vis-a-vis what probably the situation was, say, a year back. And that's the reason we have seen from April 23 onwards, we have a pause on the interest rate upcycle. So fundamental factors we discuss equally important are the equity flows. From October 21 onwards, foreign portfolio investors were withdrawing money in good chunk, and it kept on happening till February 23. And that's the reason, despite having quite a strong earning growth, corporate profit growth, the market did not move at all. Like, just to put a point in perspective, in September, October 21, so almost 2 years back, Nifty used to have 18,600 level, and now probably 7-8% up move after the recent inch of what probably we have seen. Despite the earning remaining quite strong at the market level, like almost 15% CAGR in last 2 years. So it had to do with the technical factors that the foreign portfolio investor withdrawing the money despite our fundamental remaining strong. It had more to do with the global concerns the FPIs might be having, that it's a flight to safety rather than anything else. At the same time, when the FPI were withdrawing the money, our domestic institutions were pumping a lot of money because there is a structural shift, like SIP for the regular investment being done by, say, retail investor. It has increased significantly. If you look about 2 years back or 2.5 years back, if the monthly CP used to be close to 8,500 crore, now it's close double the number. So we are talking about 17,000 crore monthly CP. Basically, we're talking about, say, more than 2 lakh crore annual inflow happening through the mutual fund route itself. This is a snapshot how our own economy stand vis-a-vis, say, global economy. So probably India is the brightest spot, like after having a strong run on the GDP front in 2021 and 2022, it should continue even in time to come. Like expectation is that CY23 and CY24 more than 6% GDP growth, vis-a-vis world GDP growth of close to 3%. So India will be among the economies which will be the driver for overall global economy as well. This is something I spoke, like if you look from FY12 till almost FY20, the earning growth had been quite muted. And post-COVID, there had been significant acceleration as far as the earnings are being concerned. Like from FY20 to FY24, you can say the earnings overall getting almost double. And it's going to continue even in FY24 and in FY25. So this is a bit more comforting, and it also suggests the kind of traction is there on the ground. So whatever the price movement we have seen in recent time, it's backed by the strong fundamentals as well. This slide just suggests that whatever the stock market performance we are observing, it's backed by, say, improvement in the corporate profitability. So the fundamentals are intact and improving by every passing year. As I mentioned, like last 2 years, earning growth had been quite resilient. At the same time, markets did not respond, and that's the reason, say, they had been derating at the market level. And today, the 10-year average P is quite similar to where the market P would be as we speak. At the same time, we have to understand that the mix has changed within the benchmark composition, and mix has changed in favor of sector which are traditionally attributed relatively higher valuation. So theoretically, the valuation of say Nifty can be higher than the 10-year average, a fair valuation if we consider. The snapshot of the Q2 FY24 earnings. So capex-led volume growth sustained in Q2 FY24, with steel and cement consumption growing at 7 to 8%. Domestic consumption was relatively muted because there was inflation. There were pockets like rural India is not doing well. So multiple issues, and which led to some concerns related to the slowdown on the consumption side. At the same time, there were offsetting factor as well, like commodity environment was relatively more benign, which helped to have say margin expansion, and that's the reason earning growth were relatively quite superior with a top line growth over there. Financial sector delivered numbers in line with the expectation. It was quite robust, if I have to say so, like having a strong top line growth, also supported by lower provision, led to a significant bottom line growth. Chemical and pharma intermediates witness pressure because there are issues as far as the export-led sectors are being concerned because of the weakness in the global demand scenario. IT earnings were relatively muted, but it was well in line with the expectation. Auto sector witnessed margin expansion as it got the benefit of the lower input costs as well as the benefit of the operating leverage. Consumer discretionary spending got some impact because there is a shift in the festival season. So last year, Diwali was early, and that's the reason part of the sale which happened in Q2 would be now happening in Q3. So ideally, Q2 and Q3 should be looked combined. So if there was some weakness on the Q2 front, we will like to believe that the Q3 will be relatively stronger, and that's the reason in the coming quarters there should be better delivery as far as the earnings are being concerned for the consumer discretionary companies. From the outlook perspective, most of the management commentary suggests that consumer demand should have an uptick in the coming quarters. Capex likely to sustain. Ensuing Rabi season is something to watch out for. And geopolitical situation is now happening on the regular interval, and it remains a key monitorable. If we think about the domestic resurgence portfolio, there are four mega themes on which this particular product is being made. Like one is the Indian consumption, second financial, third India infrastructure and manufacturing, fourth is the digital India. From the consumption front, as we have argued in past, that having higher income means that people will be having relatively more consumption for the discretionary products, and they will move beyond the staples. So when income increases, affordability increases, lifestyle changes, which is a good news for the overall discretionary spending as well. We are relatively younger, which suggests that we should continue to have a good source of working age group for many years to come. From the penetration perspective, there are many categories which are under-penetrated, and that's the reason offering a long-term growth. So long-term growth perspective, we have a long way to go, and consumption should be a resilient long-term theme. If we look the recent performance, we should see everything in the context that how the global markets are behaving, how the local situation is unfolding. So from the staple front top line growth may look muted, but OP growth, PBT growth was relatively more strong. Reason was that because inflationary pressure have come down, that's the reason many companies have either cut prices or passed on the benefit of the lower commodity prices. That's the reason, say, top line growth look muted, but at the same time, when the commodity prices are coming down, it help in the gross margin expansion, and that's the reason higher operating profit growth over there. Retail, despite having a strong operating profit growth, it did not translate into equally strong OP growth. As I mentioned, that part of the retail sales will be happening in Q3, and that's the reason negative operating leverage in Q2 had some bearing on the OP growth over there. Discretionary impersonal like paint company had decent volume growth, like ranging from high single digit to low double digit. Gross margin expansion was quite sharp, which led to almost 30% plus operating profit growth over there. Beverages companies delivered quite a strong number after relatively weaker performance in the Q2. So if we think about the margin scenario, those are expanding with last year. So Q2 FY24 margin almost 200 basis point up vis-a-vis last year in the staple. Similar is the situation for discretionary impersonal and say beverages, QSR, and so on. At the same time, if we compare the same from the pre-COVID scenario, like Q2 FY20, there is still scope to move up. So that's the reason we think that in the second half onwards, when the top line growth inch up, supported by, say, further scope for the margin expansion. So bottom line growth should be quite strong in the consumption sector. Financial is the second big theme. So if we look the recent history of last couple of years, that the credit growth has inched up, and it's a broad base, like whether it's a private bank, PSU bank, everybody is doing good as far as the credit growth is being concerned. From the sector perspective, the gross NPA, with say gross advances have come down. They peaked out in FY18 and now they are a lot more manageable. And private banks have done relatively much better either in past and they continue to do well even in recent past. That's the reason we are seeing that ROE have improved for our country. Like from 2018 onwards, they are inching up, and probably one of the few economies where the significant improvement is happening. Third theme is infrastructure and manufacturing. So whether it's a railway, electrified railways, metro network, airports, road network, everywhere we are seeing a lot of progress. And it should augur well for the overall, say, economic growth in time to come, because these are the foundation which we are putting in place, and the benefits of the same should be visible in coming years as well. And what is driving the investment? Like it's a China plus one, which we know had been a buzzword, especially from COVID scenario, post-COVID scenario. And in last couple of years, Europe plus one is another thing which is coming into the picture, especially post Russia-Ukraine scenario, when the cost of doing business in the Europe has moved up. So alternatives are being looked at, and India stand out in that particular regard. India is large domestic market, which also have many favorable factors like supply of manpower, government focus on the supply side economics, and there the policy benefits like PLI. So whether it's a GST, government expenditure, etc., everything is suggesting that things are moving in the right direction and picking the traction. Fourth theme is the digital India. So we have seen COVID happen. It was a crisis, but it also provided an opportunity that a shift in favor of the digital. And that's the reason whether it's a Phone Pay, Google Pay, all of them started having a lot of traction as far as the uh, payment system is being concerned. And monthly UPI value is rising just like anything, exponential rise, which we have seen in the last 3-4 years. DRP, if you look last 5 years, so portfolio companies put together had significant alpha as far as the earning growth is being concerned. Like last 5 year average earning growth for the portfolio had been almost 22%, with 16% for the Nifty. And we do believe it should continue. Like even in Q2 FY24, the DRP portfolio earning growth would have been 39%, with Nifty would have been close to 28% or so. And we expect in FY24 and FY25, the earning growth should be more in the range of 24 to 25%, which is again relatively quite high, with say Nifty over there. DRP psychographic. So we are overweight in the financial sector, consumption sector, infrastructure, and engineering sector. So consumption, we cover beverages, discretionary, impersonal, footwear, retail, staples. So every part or say different aspects of the consumption is being factored in. In case of infrastructure and manufacturing, we have a significant overweight position, whether it's a cable company, cement company, and so on. We have some exposure towards the chemical and the utilities companies as well. From overall psychographic perspective, like earning growth remain quite strong as far as the coming years are being concerned, like more than 24% or so. At the same time, all the other metrics like whether it's a return on capital employed, everything is improving over there. If we look last 4 years, so there had been many up and down, whether it's a COVID-1, then COVID-2, then Russia-Ukraine, and then we had various geopolitical situation and significant up and down. As we know, whether stock return or the portfolio return, they are a combination of two things, like what is happening to earning and how the multiples are behaving. So in last 4 years, whenever any crisis happen, we have seen the stock market first respond negatively and the valuation derating happen. As we speak, the valuation are quite close to the bottom being observed during the COVID time. So it suggests that probability that probably it will go down from here looks relatively lower. As we speak, valuation is still lower than the average being experienced in the last 4 years. So from the probability perspective, that valuation may either remain stable or if at all they correct, the probability of the same is relatively lower. If that's the case, then future earning growth should lead to a situation that a decent part of the future earning growth translate into the stock return. This is how the DRP performance had been, 1 year basis, close to 19% return vis-a-vis say 13% for the benchmark, and 5-year CAGR would be close to say 16%. One thing I would like to highlight that if we look the left side bottom table, so till 2021, the earning portfolio CAGR was close to 21% vis-a-vis say 19% for BSE 500. There was underperformance in CY22 because there were certain sector companies which did well for the benchmark. At the same time, some of our companies did not do well. We are making up for the lost ground. So in CY23 till November 23, so basically this calendar year, last 11 months, the portfolio would have delivered close to 23% return, vis-a-vis say 17% for the BSE 500. If we think the same from the financial year perspective, so FY24, basically April 24 till November 23, the portfolio return was close to 19%, vis-a-vis say benchmark close to 24% over there. This is a snapshot of the company which have done well and the companies which were actually dragged. So Polycab, Varun Beverages, Chola, APL Apollo, KI Industries, they did quite well in last 1 year and provided a boost to the overall portfolio performance. Page, Infosys, Dixon, etc. So they brought down the or had some negative bearing on the overall return over there. This is just a summary. Like if you look last 30 years, that generally we can say that earning growth and price performance go hand in hand. That stock market performance does require that the earnings are coming, but there is always some lead and lag. Like last 4 years, the earning growth was quite superior, but did not translate into the stock return in the same quantum. If you compare FY08 to 19, the earning growth was only 6% CAGR, while the price performance was 8.6%. So some lead and lag do happen, but as long as the earning growth remain robust and continue to come, it does suggest that sooner or later it's going to translate into the stock return as well. It's a trailing chart for the Nifty valuation that multiples have corrected quite a lot more reasonable. So if the future earning growth is coming, then there's high probability that it will convert into the stock return as well. So this particular product is primarily focused on the domestic themes. So if country is doing well, different aspects, whether it's a consumption, manufacturing, financial should do well. And we can tap most of those opportunities through this product. I will just stop over here and we'll happy to have any question.
Kuldeep, I think your screen was frozen. Can you just repeat the last sentence?
So I'm just saying that this particular product is focused on the domestic themes, so whether consumption, financial, manufacturing. If India is doing well, those themes are doing well, this particular product should do well as well. So I will be stopping over here and happy to have any question.
Sure. Thank you so much, Kuldeep, for that update. So we have a few questions from the audience. We'll try to take them first, and then I'll ask you questions that I have prepared with. So the first question that I'd like to take is, somebody has written and asked us what new have we added. Okay, so what are some new areas of domestic theme that we have? I mean, more stock specific, not just sector specific. If you can give us a couple of examples there, I know we have added in the portfolio. So if we can just update from you. Over to you, Kuldeep.
So in last 2-3 months, we have added metro brands. So it was added about 3 months back. The stock has done quite well. Because we believe that footwear as a sector is still a long way to go. There's significant unorganized component in that particular sector. And as far as the metro brand is being concerned, it is among the most disciplined player, having a history of delivering, say, results on the sustainable basis. And we believe this company can deliver, say, earnings in high teen for at least a decade or so. So a very strong company in the footwear sector, having history of consistent delivery. So Metro brand is one of the name. Second, we added the JSW Infra. So recent listing. Again, JSW Infra is the number 2 port player in the country, and it's coming from the JSW group. So almost 2/3 of the volume is captive. As we know, JSW group is expanding across various sectors, whether it's cement or steel. So if they grow, this particular company should benefit because of, say, volume coming from the group. At the same time, 1/3 of the port volume also comes from the third party, and that is the area where the growth can be faster. So this particular name had been taken considering that the infrastructure spending is happening. Overall, say manufacturing will be thriving. So if we want to have a proxy, this is probably one of the name to go for. So these were the recent, say, addition. Apart from that, Varun Beverages, Radico Khaitan, on the beverages side, continued to do well. Titan had been consistent performer, and so on.
Right. So Kuldeep, before I move to the next question from the audience, the three names that you mentioned, Titan, Varun Beverages, are more B2C focused, and I have observed the portfolio being kind of B2C heavy, that is business to client or retail, kind of consumption. Is that by chance, or is it something we heard about discretionary income and income levels going up? So what's your take on that and overall portfolio composition?
So if you think our own GDP, almost 60% is driven by private consumption. So we want to have a decent exposure coming from that particular area. And when we say private consumption, 30% is retail, 30% non-retail. And a large part of that is B2C. So we want to cover most of the bright spots available in the consumption domain. It may be staple, it may be discretionary, it may be beverages, retail, or say luxury. As long as country is doing well, having higher income, and probably the need move from staple to, say, more lifestyle change, premiumization, and so on, this particular part should do well. So it's quite linked to the direction the country has taken, and probably this is the area where relatively faster growth will be happening. Reason is that not only the consumption will be growing more likely in line with the nominal GDP growth, there is significant component of this unorganized player. And this transition from unorganized to organized is bound to happen, because when the aspiration go up, people look for the branded products. And as the company increase the distribution reach, affordability increase, scale increase, all these work in favor of these companies. So it's more of a choice that we want to have a significant exposure on different areas of the consumption. And that's the reason we have built this particular product as a matter of a choice. And then we think about, say, financial, they are also facilitator of this particular consumption, whether it's Chola or, say, Bajaj Finance and so on. Everybody is trying to facilitate the consumption part of it. So it's true that B2C is a relatively larger part of the overall portfolio. That is an area where fair play, more driven by demand and ability to, say, sustain their profitability and so on, high return on capital employed companies. So all in all, that is the area where we want to be. That's how we have thought about it.
Right. Thank you, Kuldeep, for the detailed answer. So in one of your last slides, you showed us how lead and lag work between earnings and actual price returns. Okay, so in the portfolio, we'll always have certain kind of stocks which have led their earnings, but maybe the price is lacking. Okay, somebody has pointed out, Mr. Omkar has pointed out a couple of stocks, like Navin Fluoride, Dalmia Bharat, ICICI, Reliance, HDFC, where there has been certain kind of lead and lag effect there. What is your view on this aspect of the portfolio and your answer to that?
So when we take any company, what we expect from them? They should deliver earnings. Price performance or stock market performance is driven by how the different participants are thinking about it. So most of the name which you have mentioned, whether the Reliance, Financial, and so on, or for that matter, some consumption companies as well, there the foreign portfolio investor holding will be relatively higher. So if they're selling right from say October 21 till February 23, they can sell what they hold. And they were relentless seller for quite some time. And that's the reason we have seen some pressure. So I would say there was nothing wrong from the fundamental perspective. In fact, the companies were delivering quite strong earnings. And because they had been relentless selling, the valuation have become relatively more reasonable. So you think about say HDFC Bank, ICICI Bank, or many other BFSI companies, the valuation correction would be almost 30% to 40% if we compare pre-COVID till date. And there's a limit how long this derating can continue to happen. And probably we have reached to the level where the scope or the probability that valuation coming down further looks lower. And if that is the case, then future earning growth should translate into the stock return. We would be really concerned if the earning growth is not coming. If earning growth is coming, not translating into the stock return, it's more of a say response getting delayed, not denied, if I have to say so.
Right, and you would largely be okay as long as earning goes, and that is our response to our investors, and is our responsibility to tell our investors that what is important is the earnings. Like Kuldeep explained, lead and lag in the share price happens. It's we have to keep our objectives straight here to answer that question, Mr. Omkar. Another question, Kuldeep, has come on defense and PSU stocks. Now, this has been spoken about a lot by many market participants, and they also form a core domestic kind of a theme. Okay, where the Tejas aircraft is one such example where our self-reliance is coming out. And what is your view on this space as a whole?
So this is one of the area where a lot of things are happening or had been happening for quite some time. So we keep on evaluating those opportunities, and it's always about the relative choices, like what we hold with what we are looking at. So from theme perspective, completely agree that a lot of action is happening and the fundamentals are improving. So this is the area where we continue to have close watch. And it's always a relative stuff, like what you want to take out and what you want to bring in. So difficult to predict at what juncture, if at all, we have to do it. But from the theme perspective, relatively quite positive, and sometimes we play all these things indirectly as well, like as I mentioned, manufacturing, infrastructure, etc., is almost 20% of the portfolio. So, and given these are the concentrated portfolios, so there are limitations how many names can become the part of the portfolio. So we have Polycap, KI Industry, JSW Infra, and so on. So we have tried to cover broader aspects of the overall economy. The reason is like, I just give an example. If you think about Polycap and KI Industries, for Polycab, almost 90% of the business is coming from the industrial side. For KI, it's almost 100%. Like if you think about cable and wire, 100% business for say Polycab, almost 70% is say industrial capex, 30% is residential capex. When you think about related to industrial capex, it does include say what this company is providing to defense companies, solar companies, and so on. Same is the case with KI.
Your internet connection is again, I think, a little off.
Hello.
Yeah, Kuldeep, we can hear you. Please go ahead.
Yeah. So basically, I'm saying that at times, even though we may not have the direct exposure, but we try to maintain the exposure through the proxies. Like I mentioned, if we have a polycap KI, and if we look their composition, almost 70% is industrial capex. And when we think about industrial capex, they benefit when infrastructure is doing well, defense companies are doing well, say solar projects are being put in place. All these things, when they are happening, they are the provider of those, say, cable over there. Same is the case with the, say, wire part. Like if residential, say, real estate is doing well, these people also benefit. So it may appear that the direct, say, name is not available, but at the same time, we have tried to have a decent exposure towards the same through these proxies.
Yeah, Kuldeep, I think Sankalpo is just rejoining. Just a second. Yes, Sankalpo. Yeah.
So, Kuldeep, we lost you in that question on, I think, the last couple of lines. So,
actually, no, Sankalpo, we were able to hear him.
Okay.
Maybe we can move on to the next one.
Right. So we'll move on to the next question. Okay. The next question that I want to ask to you is, Kuldeep, largely a lot of Indian companies are now getting global in the sense that they derive the majority of their revenue from outside the country. Okay. And I know for a fact that there's some allowance for that in this portfolio. Okay. So for example, IT and pharma. So how do you look at that allocation in this portfolio, and what are you thinking about if you get a company like that? As of now, I think majority of the companies do derive their revenues from India and cater to domestic consumption. But how will you use the the other bit of the portfolio, other bit of the market?
So if you look about the construct perspective, there is a flexibility that we can have up to 25% name having the export theme. So currently only a couple of names are there, like Reliance, you can say, and Naveen Fluorine, say mid to high single digit exposure through the export led name. Currently, we do not have any IT name or say pharma name. So from IT sector perspective, you look, if you think like pre-COVID, that sector used to deliver high single digit to low double digit earning growth, pretty good, pretty strong cash flow, dividend paying sector, and so on. The only issue with that sector is the growth. So post-COVID scenario, there had been some acceleration because many digital transformation projects were coming up. After that, I would say this is the cooling off period led by, say, weakness in the global economy, because almost 75 to 80% business terms come from US or the European markets. If those economies are not doing well, so they are going to have some implication for the IT sector. Having said that, about 24 will be relatively muted, and about 25 largely should be the normal delivery, like high single digit growth or so. So from the growth delivery perspective, the earnings will normalize, but not coming at the level where we are having interest. So like mid-teen, high-teen earning growth. So that is not possible in case of IT. Pharma has done relatively better in recent past. So this is one of the interesting area where different reason, like domestic pharma a bit more resilient. In case of global pharma is being concerned, probably the competition has come down to some extent, price erosion has come down. So that is an area which is on the watch list. So if we find something interesting, we can think about those things. So from construct perspective, we have the flexibility to introduce the export-led name up to 25% of the portfolio if we believe there are the merits.
Right. Thank you so much for that answer. I hope that answers few client queries on that aspect of the portfolio. The next question that I want to put to you is, Kuldeep, you've focused on the consumption, trends in India. Also, you've shown in your slides how discretionary income and how income levels are increasing. If you can just highlight what are the trends or shifts in trends that you will be watching out, with respect to consumption or changing consumption from the portfolio perspective.
So first of all, if you look in the coming agri season, like Rabi season, we will have to look how the crop is, how remunerative the crop is, because it's going to have implication for the rural consumption and so on. So this is one of the area to look forward. Second is the obviously inflation part, because if the inflation is high, it hurts the affordability quotient. Inflation has to be manageable for consumption to move up. So these are a couple of things we will be looking in coming quarters, coming years over there.
Right, thank you. So this is again a question that has come from the audience. I'm just trying to modify it a little bit. So a lot of times, like you said, like we saw, the portfolio is B2C focused and consumption focused, be it be financials or some other kind of company. Stocks or businesses in this portion might not always be the cheapest in terms of the valuation matrices. So what's your view as a portfolio manager on valuation? What role does it play from the perspective of a company being in the portfolio or not being in the portfolio? So what do you?
So valuation should be looked from the long-term earning growth perspective rather than near-term earning growth. And because if the sustainable earning growth is relatively higher, then high likelihood the valuation will also be higher. So as I mentioned that this particular portfolio is having a significant component coming from, say, consumption and so on, where the long-term sustainable earning growth will be quite resilient, quite decent, quite strong. So that's the reason we should appreciate the valuation from the perspective that whether we are thinking in years terms or decades term. So I will just give an example. Suppose a particular company is having 20% premium, say valuation perspective with its peer group and so on. But if our holding period is say 5 year, 10 year, we have to amortize this 20% over that longer tenure. So first criteria should be the business, like how big this business can become in time to come, basically the opportunity. And then the management, like because that also decide the corporate governance issues and so on, and the ability to execute. So if the opportunity is good, management can execute and deliver, a strong earning growth is there, then after factoring in all those things, then the valuation follow. Because even though we can say there are more than 5,000, 6,000 companies, but when we apply different parameters like whether the good management, good opportunity, sustainable earning, high ROC, and so on, actually we have a limited set to choose from. And a good company having a strong track record is generally not only the exploiter, like in a sense that they are doing well in the current business, they're explorer as well. Like they keep on looking for the new opportunity. So we have to factor in that particular part as well, like companies' ability to explore, adding new revenue line. So those are the things probably difficult to attribute when we think about a year or 2 year. But when we think about 5 year, 10 year, and we have seen the track record of the management that they keep on identifying the new areas, new adjacencies, we have to account a premium for that particular part. So valuation is a bit more subjective in a sense that it's more sector to sector basis. Within sector, there are companies which deliver the earning for only for year or two or more episodic in nature, and there may be other companies which deliver the earnings on more sustainable basis. So first is the opportunity, followed by management, then the ability to deliver earning, and then followed by the valuation.
Right. Thank you. I hope that answers the question on valuation. So Kuldeep, another question that we often get is on the segment of market, and you also spoke about it, that did well in the last couple of years, is the utility space. Okay, so we have some presence in utility through maybe Gujarat Gas, okay, in the portfolio. What's your view broader on the sector? And someone has asked this question wanting to understand our view on this.
So utility sector, how you decide value? Like generally, those companies do deliver lower earning growth. At the same time, the valuations are also lower. So at times, depending on the mood of the market, they may be underappreciated or overappreciated. So if the infrastructure is coming on stream, if the electricity is reaching to hinterlands, there is high likelihood that all these companies should also benefit. And that is something which we are observing, whether it's a power consumption, diesel, petrol, all those parameters suggesting that on ground there is a decent, resilient consumer demand, and that's the reason these companies are delivering the decent earning growth. On the those things have also done well. So the way I think about it, like we have put in place the right founding stones, and the benefits of the same should be visible. If we can just maintain what we have seen in recent time, like high single digit sort of volume growth for all these utility related areas, um, I believe that there should be a decent appreciation for that particular part.
Right. So, Kuldeep, I remember you spoke about how we're using finance as one of the four themes in the portfolio. So, and this probably can be a concluding question. Recently, RBI had raised some risk weights for this part of credit card and non-collateralized or non-securitized lending. So, and in the recent years, we've seen this segment grow and become quite large, and retail credit growth coming very well, growing very well. What is your view on this move? And what is your broader view on the credit growth for retail?
So they have taken some action like increasing the risk weights, especially related to the unsecured lending and so on. The way we should think about it, like our central bank had been a lot more proactive vis-a-vis many other central banks. And that's the reason we came out from the crisis uh, relatively in much better shape vis-a-vis many other economies would have done. So whatever the action they are taking, it's more preemptive rather than reactive. And if the demand is there, the companies or say banks can pass on the cost of increase in the cost of financing to the say end user. So they want to have some discipline as far as the growth is being concerned. So you would have seen there were certain pockets unsecured lending were growing relatively at a faster clip. So rather than waiting for any untoward incident to happen, they are just suggesting that tighten your belt, do it in a more disciplined manner. So it's more disciplined aggression being suggested rather than getting undue concerned about it. So from credit growth perspective, we will like to believe as long as the overall economy is doing well, there is a credit multiplier. So overall credit growth should remain double digit. And the companies which have the track record of doing better than the underlying credit growth should continue to do well. So I don't think that anything is going to change structurally. It's more about getting more calibrated, more disciplined rather than anything else.
Right. Thank you so much for that, Kuldeep. Thank you to the audience for joining in on a Friday evening. We will see you soon. If you have any questions unanswered, please do reach out to your ASK RM. Thank you, Kuldeep, for your time. Thank you to the audience.
Thanks a lot.